Are you tired of the idea that debt is always bad? Well, it's time to rethink that notion. In this video, we delve into the 8 effective methods that wealthy individuals use to profit from debt. Join us as we explore how smart borrowing can pave the way to financial success. Discover the secrets of using debt wisely to achieve prosperity. Watch the full video to learn these strategies and take a step closer to financial freedom. Don't forget to subscribe and hit the like button to support our channel. Before diving into strategies, let's address a critical question. Can you use debt to get rich? Sometimes, borrowing money can actually help you build wealth, especially when you use it for things like education. Here's how it works. Lots of students take out loans to pay for college. Even though it might seem scary to start with debt, most college programs end up being pretty good investments. Why? Because they often lead to better paying jobs. So even though you're borrowing money for your education, that education can help you make more money in the long run. When you earn a bachelor's or a higher degree, it's like unlocking a door to higher paying jobs. These jobs can bring in more money over time, which helps you pay off the debt you took on for your education. As you make more money because of your degree, you're getting richer slowly but surely. So, while it might feel like a big deal to borrow money for education, if you use it to get a degree that boosts your earning potential, it can actually be a way to become wealthier over time. Now, let's delve into the differences between bad debt and good debt to better understand what sets them apart. Understanding the distinction between good debt and bad debt through examples clarifies their impact on your financial future. Good debt involves borrowing money for assets that can grow in value or generate income, such as investing in shares, property, or managed funds. For instance, taking a loan to invest in property might increase its value or produce rental income, allowing you to pay off the debt while owning an appreciating asset. On the flip side, bad debt encompasses borrowing for items that don't increase in value or generate income, like using a credit card for shopping without paying off the balance before interest accrues, or taking a loan for a vehicle, which typically depreciates in value. For example, failing to pay off the full credit card balance incurs more costs due to interest, while a car loan for a depreciating asset results in ongoing payments for something that doesn't add value over time. This understanding empowers you to discern between debt that can potentially benefit your financial growth, good debt, and debt that hampers your financial progress, bad debt, aiding in making wiser borrowing decisions. Now that we've established the difference between good and bad debt, let's explore the 12 effective strategies that financially successful individuals employ to profit from debt. These methods, when used wisely, can pave the way to substantial financial growth and prosperity. Number 1. Improvements to homes. Imagine you want to make your house even better, like adding a new kitchen or fixing up the bathroom. Sometimes to do these improvements, you might not have all the money right away. That's where personal loans come in handy. Now, when you own a house, it's like having something really valuable that's yours. Making your home better by doing these improvements can actually make it even more valuable. So, let's say you borrow some money through a personal loan to make these changes. If the improvements make your house worth more, it's like you've invested in something that could be worth even more money later on. So let's say you decide to sell your house someday. If you've used that loan to make improvements that have increased the value of your home, you might be able to sell it for more than you bought it for. That extra money you get from selling it could be more than what you borrowed, which means you've made a profit. That's one of the cool things about improving your home with a loan. It's like investing in something that could make you more money in the future. Number 2, home reselling. When investors want to make quick money, they sometimes use special loans called hard money private loans to buy houses. With these loans, they purchase a house that needs fixing, hoping to make it look better and sell it for more money fast. This quick buying and selling of houses for profit is known as house flipping. It's a bit risky because things need to go just right for them to make a profit. They have to buy the house at a good price, fix it up nicely without spending too much, and then sell it at the perfect time. If they manage to do everything carefully, they might end up with more money than they started with. But it's a bit like taking a chance. If they don't do things right, they might not make any money at all. Number 3, leveraged ETFs. Leveraged ETFs are like turbocharged investments that allow you to amplify your gains or losses by 2 or 3 times the regular movement of an index or sector. They're offered by companies like ProShares and track specific indexes, bonds, commodities, or sectors. During good times in the market, these ETFs can generate really high returns, way more than usual. However, the catch is, they can also drastically increase losses. If the market goes against your bet, these ETFs can wipe out your entire investment fast. They're attractive for big potential profits, but they're risky. If you're not skilled at trading in and out at the right times, the losses can be much larger and happen quickly, impacting your investment in a few days. They magnify both the good and the bad, so it's crucial to understand their volatility before investing. Number 4, start your own business. When it comes to using debt, specifically personal loans, to build wealth through starting a business, it's about leveraging borrowed money to kick off a new venture. Starting a business is exciting, but obtaining traditional business loans early on can be challenging because most lenders want to see a track record of success. Here's where personal loans can be beneficial. They offer a way for new entrepreneurs to access the funds they need to launch their business, even when they might not qualify for regular business loans. However, not all personal loan providers allow their funds to be used for business purposes. Some lenders have specific restrictions on how the money can be used, and they might not permit using personal loans for business expenses. This makes it really important to thoroughly check with lenders before borrowing to ensure that they permit using the loan for your intended business purposes. Lenders have different rules and limitations regarding what the borrowed money can be used for, and it's vital to be aware of these restrictions. Verifying the terms and conditions with lenders is crucial before deciding to use a personal loan for your business, ensuring you're in line with their policies and avoiding any potential issues down the road. Number 5, hedge funds. Hedge funds are like supercharged investment pools. They often borrow a lot of money to make larger bets in the financial markets, aiming for higher returns. Some hedge funds borrow up to 10 times more money than they actually have to invest. This strategy has made billionaire managers like John Paulson very successful, turning some investors into multi-millionaires. However, if the hedge fund manager makes a wrong move or their investment idea doesn't work out as planned, it can be catastrophic. For instance, Long-Term Capital Management, LTCM, borrowed a whopping 30 times their actual assets and faced huge losses. They needed a rescue because their bets went wrong, risking the money of all the investors involved. Essentially, while leverage can magnify gains, it can also multiply losses, sometimes to a degree that could lead to the fund collapsing and investors losing their money. Number 6, short selling. When you hear about shorting the market, it means making a bet that a specific stock will drop in price. Here's how it works. A short seller borrows shares from someone who owns them, then sells those borrowed shares, hoping their price will fall. If the stock price does indeed go down, the short seller buys back the shares at the lower price and returns them to the original owner, making a profit from the difference. However, the tricky part is that if the stock price goes up instead of down, the short seller can face unlimited losses because there's no cap on how high the price can go. Short sellers can make a lot of money if they're right about a stock dropping, but if they're wrong and the stock rises, they might end up losing way more than they initially invested. It's a risky strategy that requires careful timing and understanding of the market. Number 7, Forex Trading. Forex trading is like a way to play with big amounts of money using just a small portion of your own. It's super powerful because you can control a lot, up to 100 times, more money than you actually have in your account. The cool part about currency trading is that you can turn a little bit of money into a lot really fast. For example, George Soros famously made $1 billion by betting against the British pound. He's called the guy who broke the Bank of England because of this successful move. But, and this is a big but, trading currencies can also be super risky. If things don't go your way, you can lose a lot of money really quickly, sometimes wiping out your entire account in just a few minutes. It's like a super fast roller coaster. Exciting, but you gotta be careful because it can take you on a wild ride with big ups and downs. Number 8. Managing cash flow. Managing your cash flow is crucial when building wealth, as it allows you to monitor your income and expenses, ensuring you don't miss payments and maintain a healthy financial balance. Using debt strategically to accumulate wealth can involve employing cash flow management to your advantage. Making loan payments ahead of schedule can be a savvy move. By paying off debts early or ahead of the required timeline, you can potentially reduce the total interest you pay over time. This could free up more of your future cash flow for investing or furthering your wealth-building initiatives. Keeping a keen eye on your cash flow enables you to strategically allocate funds, potentially allowing you to pay down debts faster and make more efficient use of borrowed money to propel your financial growth. Number 9. Debt consolidation. Debt consolidation involves combining multiple debts, such as credit card balances, into a single, more manageable loan, often a personal loan. Instead of juggling various high-interest debts, individuals opt for a personal loan that covers the total owed amount. This simplifies the repayment process by having only one monthly payment, often at a lower interest rate compared to the individual rates of the previous debts. By consolidating debt with a personal loan, you could potentially reduce the overall interest payments. Lower interest rates mean more of your payment goes towards reducing the principal amount owed, allowing you to pay off the debt faster. This financial strategy frees up funds that were previously going towards high interest payments, giving you more financial flexibility and potentially allowing you to allocate those savings towards wealth-building activities like investing, starting a business, or growing your assets. Number 10. Strengthening the impact of your savings. Many individuals prioritize having cash savings in emergency funds or buffers for peace of mind. However, an alternative strategy involves using an offset account connected to your mortgage rather than keeping cash in a traditional savings account. An offset account is linked to your mortgage, and the balance in this account is subtracted or offset against your outstanding home loan balance before calculating interest. Essentially, the money in the offset account works to reduce the interest you pay on your mortgage while still being readily accessible. By utilizing an offset account, you won't need to lock away your savings. Instead, your savings effectively reduce the interest on your mortgage. This strategy not only helps you save on interest payments, but can also potentially shorten the duration of your mortgage. As a result, you can simultaneously benefit from a higher after-tax return on your savings while accelerating the payoff of your mortgage without sacrificing access to your funds in case of emergencies. Number 11. Recycling debt. Debt recycling involves converting non-productive or inefficient debt that doesn't generate capital growth, revenue, or isn't tax deductible, into potentially more beneficial debt that generates capital growth or income, or is tax deductible. One way to execute debt recycling is by using a lump sum, such as a bonus or inheritance, to pay off non-profitable debt. By settling this non-profitable debt, you essentially clear it off and then potentially re-borrow the same amount through a tax-deductible loan. This borrowed amount can then be invested in assets that have the potential to generate income or capital growth. The key idea is to leverage the tax-deductible debt for investment purposes, aiming to generate wealth and potentially benefit from the income or growth produced by the invested funds. This strategy aims to optimize the use of debt by transforming it from non-productive to potentially wealth-generating, maximizing the financial benefits of borrowed funds. However, it's important to approach this strategy carefully, considering risks, potential returns, and consulting with a financial advisor to ensure it aligns with your financial goals and risk tolerance. Number 12. Margin investing. Investing on margin essentially involves using borrowed money to buy more stocks than you could with just your own funds. When you open a margin account with a traditional brokerage, you're allowed to invest a percentage of the stock's purchase price, typically up to 50%, with the remaining amount borrowed from the broker. For instance, if you have $50,000 in cash, the broker can lend you an additional $50,000, giving you a total buying power of $100,000. This leverage can amplify your gains if the stock price rises. For instance, if the stock appreciates, you can sell it, repay the loan, and keep the profit. However, the risk is that if the stock value falls and your account equity drops below a certain level set by the broker, you might face a margin call. This means the broker will ask you to deposit more money to cover potential losses. If you can't meet the margin call, your broker can sell your stocks to recover their loaned amount, potentially leaving you with losses. Essentially, it magnifies both gains and losses. Now, here's a bonus method favored by wealthy individuals to profit from debt: investing in a managed geared equity fund. Investing in a managed geared equity fund allows you to benefit from leveraging borrowed money to invest in national or global stock markets. This type of fund is geared from within, meaning the fund manager takes a loan on behalf of the investors, using these borrowed funds to amplify potential returns. However, it's important to note that this investment strategy involves a significant level of risk. While it offers potential for higher returns, it also increases the exposure to market fluctuations, potentially magnifying losses as well. Consulting with a financial expert or consultant is strongly advised before pursuing this strategy to understand its suitability for your financial situation and risk tolerance. Regardless of the efficiency of using debt for investment purposes, it's crucial to maintain a balanced approach and avoid taking on more debt than you can comfortably manage to repay. Understanding the risks and having a clear plan for managing debt is essential to avoid potential financial difficulties down the road. Consulting with professionals ensures you're well-informed and can make decisions that align with your financial goals while managing risk appropriately. I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching, and Lil see you in my next video.